Hello, this is Dale. One of the biggest reasons why retail investors lose investing in the stock market is they don't have a plan. Now, this is just like any other business we're going to run. Your trading must have a business plan. I produced this series a while back. And I first presented this at the Traders Expo in Las Vegas in November of 2009. Since then, I've had a number of modifications to this, the last one being June of 2020, but I've refreshed a little bit to make it really current. So what I want to do is go over the elements of a trading plan that's going to help you to keep focused on your trading and what you need to become a success. Believe it or not, trading is really a balance between the psychology and the strategy that you use. You can have the very best strategy that anybody's ever come up with, and unless you have your total brain engaged and your ego checked at the door, and you're taking care of your fear and your greed, and you're looking at all the psychology elements that cause people to fail, you will not be a success with just a strategy alone. You must have the combination of both. I feel one of the biggest reasons for my success was becoming an unemotional trader. With written entry and exit rules and a proven strategy, the trading almost became mechanical. Be prepared to take losses and go through losing streaks unemotionally. That's when you become a success. Just stick to the strategy. If it's a positive expectation strategy, and my strategies for trading credit spreads are positive expectation trading strategies, just stick to it and execute the trades. You are going to have losers. You are going to have losing streaks. You have to trade unemotionally. Ten things losing traders do, and this a lot of these came from the book Market Wizards that was done by Jack Schwager. He listed 10. Number one, no goal. No goal. Unrealistic expectations. A need for action. Exposing yourself to too much risk. Jumping out of the trade prematurely and too quick to take profits. Of course, if you're not doing very well, you have a lack of confidence. You need to have rules, and you need to keep records, and you need to have a rock solid strategy. And then you have to have a trading plan, and you have to keep this evergreen, and you have to follow the plan to be a success. So let's talk about the elements we need in a trading plan. We need goals. We need affirmations. We need trading strategies, trading rules, a trade size, and expectations. Trading goals takes care of this one. Affirmations takes care of unexpected, unrealistic expectations and a need for action. The trading size takes care of exposing yourself to too much risk. The trading rules takes care of jumping out of a trade prematurely or too quick to take profits. When you start to have a success, you're going to have the confidence. Trading rules also help you here, and records. You need to keep records. And when you do have losers, what did you do? Did you execute the trade correctly? If you did and it lost, that's okay. that's okay. If you did not execute the trade correctly, you need to note that and learn from that experience. Trading strategies takes care of this one, and this plan will take care of the trading plan. So having a trading plan with these 6 elements is going to take care of all the problems that losing traders have. Let's go over these. First thing I want to talk about is a book that was written by Napoleon Hill called Think and Grow Rich. He was commissioned by Andrew Carnegie to look at the traits of the richest people and could he duplicate those? And with that information, he came up with 8 steps that are necessary for the richest people and for people that want to become a success. They have to have a burning desire. They have to visualize that desire. They have to give their subconscious mind auto suggestions. In other words, they have to tell their brain what they're doing, why they're doing it, and what kind of returns they expect. You need to program your brain to think positively. Step 4 is you have to have a passion in your trading. You have to have an imagination. You have to have organized plans. When I get up in the morning, I come down to my study, and the first thing I do is review all the trades that I have, all the stocks that I'm looking at, and all the trades that I expect to make during the day, if there are any. I have an organized set, then I don't deviate that during the trading day. You have to be persistent, and you have to let your brain work. And by giving your brain ideas to work on, it will subconsciously work on those. Napoleon Hill summarized that all people have become what they are because of their thoughts and desires. Their thoughts and their desires. You are what you think is the coined phrase that Napoleon Hill has said many times. You are what you think. So let's think of the first item, and that is setting a goal. And what Napoleon Hill says is you ought to set a monetary goal and be very, very specific. This is just an example. Let's say you're trading and you want to supplement your income. And in order to do that, you want to take in $60,000 per year, about $5,000 per month. That then becomes a goal for you to achieve. Well, what do you need to achieve that? You need to write an affirmation. Well, I only have a $50,000 portfolio, so I can't accomplish that now. But my affirmation is I will be a consistently successful trader because I want to start out making $1,500 per month, which I'll consistently build to $5,000 in 7 years, requiring a $240,000 portfolio. And to do that, I'm going to trade monthly credit spread. So in other words, what I've done and what you need to do is you need to put this into your own goals and your own words. How much money do you need to make? What kind of a portfolio are you going to start with? And how are you going to build to accomplish those goals? And that then becomes your affirmation. I have used affirmations I've been trading for 4 decades, and I've used affirmations for probably 2 or 3 of those decades. And occasionally I'll go back and look at them, and it just amazes me that some of the affirmations have come to fruition that I didn't think were possible, because I had them written down on a piece of paper and I said them every day and programmed my brain to be positive and think about how I could accomplish those goals. That's the power of an affirmation. So if I look at a trading plan, and if I have goals and I have an affirmation of accomplished the first two elements. There's a myriad of trading strategies out there. I believe credit spreads, either bull puts or bear calls, for consistent monthly income are the best way to trade the market. That is my trading strategy. Yours might be something else. And then I have rules. I use the regression channel, measured moves, Fibonacci's, and I have rules when I'm going to get in, how I'm going to get in. As soon as I'm in a trade, I know how I'm going to exit a trade. You have to have rules to how you're going to enter a trade and how you're going to exit the trade. And you have to go by those rules and never deviate. Your trading is going to become very mechanical. And that's when you become unemotionally and not attached to your trading. You know when you're going to get in, you know when you're going to get out, and you don't have that anxiety about wondering how you're going to do it. So that takes care of 4 of the elements. Now we have to look at trade size, because trade size is a big one. A lot of people lose right away because they're trading too big versus the account that they have. And a couple losing trades and they're out and they say, well, that didn't work. Well, you didn't give it a chance. You didn't give it a chance. You have to look at the trade size. Let's just take a look at a couple equations that I use. And this is trade size for trading monthly credit spreads, assuming you have a large portfolio. Now you can change this to anything you want. But as a professional, I only risk 1% per trade on any trade. 1% of 100,000 is $1,000. That is not the amount that I'm going to trade. That's the amount that I'm going to risk. Now, if I have a 10-point spread on a credit spread, I've got 10 points times 100 shares per contract, or $1,000 margin required per contract. I'm going over a lot of information here. And the beauty of a video is you can stop it, you can pause it, you can screenshot it, you can review it many times. My average loss on a monthly credit spread is about $65 per contract. So I can go ahead with 15 contracts, excuse me, and that's going to give me an average loss of 65 times 15, or well within my amount that I want to risk. Now remember, this is for a large portfolio. So I can trade as many as 15 contracts, $15,000 margin. If I'm only trading the big 4, which to me are the only ones you should be trading, are Amazon, Google, the RUT, and the SPX, because those are the big boys, and you get the most credit when you trade the big boys. So if I've got 2 or 3 out of the big 4 times the $15,000, I'm well within the margin necessary on my portfolio. Now let's take a look at this and say, okay, Dale, I've only got $10,000. That's fine. $10,000, what you want to do is you want to come in there and say 1%. And you might, for $10,000, you might say, hey, I'm willing to take 2% risk. So 10,000 times 2% is 200. That's not what you're going to That's how much you're going to trade. You're gonna risk that. Okay, so if you still have $65 per contract and you have $200 that you're willing to risk, you can buy up to, what is that, about three contracts to get started. Actually, to get started, I suggest everybody do 1 contract. I used to say you ought to paper trade, but paper trade is pretty easy, because you can, if you have a losing trade, you can say, yeah, I wouldn't have done that. But if you've got skin in the game and you've got at least 1 contract, you've got real money in there, and you're going to learn a lot faster. These are realistic expectations. These are trades from actual trades from 2020, and I looked at this and used this equation that was taught to me a long time ago. And this is by taking the profitable percent of the trades times how much you gain when you do win, minus the losing percent times the risk that you had. And over the 10 years that I've been publicly giving out my alerts, I've made 72% winning trades, about 10% of margin on all those winning trades. So 28% are losers and about 66.5% of losing trades. That comes out that every time I'm going to make a trade, I'm going to make $44.60 per trade per contract. Okay. And when you go ahead and you say, okay, during the year I made 64 trades, what kind of return am I going to get? It just blows anything you can do right out of the water. And these are I've been doing this for 10 years. These are the kind of returns I've been getting for the longest time. I have to say that past performances is no guarantee of the future. However, when we put together this trading plan and you have all these elements in there, you're going to get this kind of equity curve. You want a positive equity curve. This is my curve. I've been doing this once again for over 4 decades. Okay. I don't expect your equity curve to look like that when you're first starting out. There's going to be a learning curve. You're going to need to learn how to do this. Now, what I'd like you to do is go ahead and learn more about how I trade. I put together a 12-part series teaching a robust and profitable trading strategy. It specializes on vertical credit spreads, but it can be used for Forex. It can be used in the futures market. It can be used on ETFs. It can be used in anything where you've got price associated with it. And I'm going to put a thumbnail up where all you have to do is click on that thumbnail. It'll take you right to that series. If you don't want to do that now, this is the link to YouTube to begin that 12-part series. I wish everybody good luck, and remember that the psychology of trading is something that's going to take you from possibly losing to winning and becoming a consistently successful trader in the stock market. Thanks for listening. Bye-bye now.